Hello and welcome to Ahead of the Curve. This session is focused on finance, public and private, indeed how they might combine, how in combination they might accelerate the transition to a clean, green and sustainable economy that we need to cope with the climate change problem and to bring prosperity. My name is James Cameron. I'm delighted to be joined by Professor Nick Stern. Nick has many, many titles, but he's Professor at SE. He's Chairman of SYSTEMIQ. He's also chairman of the Grantham Institute, and he's a member of the House of Lords, an independent crossbencher at the House of Lords. And we're very lucky to have Nick to be able to principally talk about public finance, but there'll be an element of connection between public and private. And to give his assessment initially about how this COP has advanced the potential for public finance to be deployed in dealing with the climate change issue. So that's first of all for you, Nick.
Thank you very much, James. It's a pleasure to be with you, as always. I've been to all the COPs since 2006. I don't know if I should brag about that, but it's a fairly wearing experience.
I can beat you.
Yeah, good for you. But this COP is unusual in a number of ways. The first is that it's the first COP that I've been to, I think the first COP, where the private sector and finance have been out in front. Governments have been moving, yes, but the private sector and finance have moved extraordinarily fast in the last couple of years. At the beginning of 2020, perhaps 5 trillion of assets were being managed by institutions which had declared for net zero. And now it's something like 130 trillion. That's close to half of the assets under management. Of course, the assets under management are only a fraction of the assets, but they're a very important part of the story. So that's an example of how far the private sector, particularly in finance, but not just finance, has gone out in front. Firm after firm outside the financial sector have declared for net zero by 2030 or 2035 or 2040. And many of them, not all of course, have thought carefully about saying that in terms of what they can do. So that's very unusual for a COP. And I think that has brought governments along because as Philip Hildebrand, the vice chair of BlackRock, said, we were on a panel together about 3 weeks ago. He described this as the biggest capital reallocation since the Industrial Revolution. And I suggested actually you probably could go back a bit further than that, maybe the Romans. And so what the private sector has seen now is that this is an enormous change, full of dislocation, disruption, but full of opportunity. And that's what they are saying now in far bigger numbers, and far bigger numbers in terms of cash than ever before. A second important difference is that, like Paris, they began with the heads of state.
Yeah.
One of the many mistakes of Copenhagen in 2009, COP15, was that they brought the heads of state along at the end, supposedly to celebrate an agreement. Yeah. But what happened, of course, is that the negotiators at much lower level just kicked the difficult cans down the road, said, we'll sort all that out when the presidents come, of course, which is madness because presidents don't sort out detailed negotiating stories. And when the presidents, prime ministers come at the beginning, they say what they want out of it. And they like to be, and that's good, they like to be ambitious. So that lifts the spirits. And one other thing, obviously one could go on, but one other thing particularly important for me and the world, because I've been working on India for much of my adult life since 1974, was India's announcement. Quite fundamental change. Half their power coming outside fossil fuels by 2030. Moving up their plans to the capacity of renewables up to 500 gigawatts by 2030, reducing emissions per unit of output by 45% by 2030. Now, just sketch a little bit on the growth rates. Suppose they grow at 5-6% for the rest of this decade. That means they peak by 2030, and that from a country with 1/3 of the emissions per capita of the world average, let alone the United States, maybe an eighth or something like that of the United States, peaking by 2030, and with going to net zero by 2070. But the big story is the declaration of how they're going to change this decade, from the country which before long will have the largest population in the world. So in those ways, this is a very unusual COP. The second week, the negotiators come, and they're grumpy old arm wrestlers. And so there'll probably be some bit negative stuff next week. But I hope at the end it'll all come out fairly positive, because this COP is the delivery COP. Paris in 2015, COP21, set the path. But this one is the delivery. And I think if you look at what I just said, if you look at some of the technological announcements that have been made in the so-called Glasgow breakthroughs, I think it all points to a spirit of delivery, which I hope will translate into the fact of delivery.
There's no doubt there'll be a lot of emphasis on implementation and the delivery mechanisms, the institutions, the kind of private law contracts that would bind, that follow this. But you're absolutely right. Every day now there have been some big announcements. One we had yesterday was an announcement of the ceasing of public finance for oil and gas, which follows the G7 announcement on coal. And these are obviously critical decisions on what public money, both at the individual country level and also at the MDB level, where you're so knowledgeable about how MDBs function. Say something about that decision and the roughly 20 billion or so that apparently is now available for other types of investment.
To start with, it's somewhat embarrassing that the rich nations have been supporting investment in oil and gas to the tune of 20 billion. But stopping it is good news. And it means that the cost of capital for investments in those dirty sectors will be still higher. That cost of capital has already risen in those sectors. And some calculations in the Paris Effect COP26 edition suggested that cost of capital discrepancy is equivalent to a pretty high carbon price. If you read across to the effects of those high costs of capital on the cost of production, and then check what would be the effects of a carbon price, which was pretty substantial. So that is very good news. And it takes us really to the subject of the financing of the investments we really do need to make.
And where we need to bring the cost of capital down for the alternatives, including in emerging economies.
Absolutely. And that is something which, my friend and colleague, he's a visiting professor at LSE and from Brookings, Amar Bhattacharya, that we've been working on. And we need to go beyond the 100 billion. 100 billion is dear to my heart because I negotiated it in 2009, where I was working with Meles Zenawi independently as a professor at the LSE, but a friend of Meles Zenawi, who's the Prime Minister of Ethiopia then, and speaking for Africa. Sadly, he's not with us now. And he was speaking for Africa, and he said very clearly that we need to do this. He said that it's not justice to foul the planet because others have fouled it in the past. And he saw the big development story, the big clean development story, as the growth story of the 21st century. We were sharing that idea, trying to promote that idea, which we hope is correct, I certainly believe is correct, back in the time of Copenhagen, which was 2009. This is a story which should have been clearer much sooner. But you have to invest to get there. It's a transformation, but it doesn't come without the investment. Very good investments, but you have to make those investments, and you have to bring down the cost of capital to enable the funding of those investments on the scale required. Now, that 100 billion will probably, which was promised for 2020, will probably be delivered next year or surely in 2023. Embarrassingly late and damagingly late, because this is a question of trust. But let's hope, and I think it will happen, that this is nailed down next year or the year after. So we lift our eyes and we look beyond. Well, certainly it has to be more than that, but we should be expressing the whole finance story in a different way.
Yeah, in combination, what the 100 billion might do to reach those trillions that have just been launched into some hopefully productive space, but will need to be drawn down into instruments that will change the cost of capital.
There's 20 billion for a starter from stopping the oil and gas. But let's look at what the finance is for, because I think it's helpful to work back from the investments you have to make and say, how can the finance that those investments need be forthcoming? Yeah. Roughly speaking, for emerging market and developing countries, not China here, because China doesn't need more investment capital, it just needs to shift it over in the right places. But if you look outside China at emerging markets and developing countries, the extra investment we need by 2030 is probably around 2 trillion a year. And we get that from looking at the kinds of particularly infrastructure that will have to be built. Probably 80 or 90% of India's infrastructure that will be there in 2050 is yet to be built. Huge opportunity, right? Yeah. But it's substantial investment that's needed there, including for urbanization, and including in India will need to quadruple its electricity capacity between now and 2050. These are very big investments. And they're investments which are about development and they're about the drive to net zero. They're both. It's sustainable development. They're wound up one with the other, and resilient development as well. So you should start, or we should start with saying the developing world, emerging markets, developing countries outside China are going to need extra 2 trillion. And of course, the whole structure of investment has to change as well. But the extra amount you're going to need is about that. And it's going to drive efficiency, productivity, resource efficiency, energy efficiency, labor productivity across the board, as well as so much cleaner, giving you cities where you can move and breathe.
Less healthcare cost.
Absolutely. And those investments are directly, privately productive, many of them. And that's another conclusion of the new Paris Effect COP26. That so much of the economy, the investments we need to make in the zero carbon activities will outcompete the alternatives, even without a carbon price or subsidy. I mean, jolly well should have a carbon price, but even without.
That would further accelerate what is happening because of the exponential nature of technology innovation.
So we're already seeing these tipping points come. The first version of the Paris Effect at the beginning of this year said that already something like 25% of emissions are in places where the zero carbon is actually cheaper already, and that it could be 75% by 2030. The new version says could be out today, it could be about 90%. Yeah. What's that mean? It means that what was a trend is now an accelerating trend. Yeah. And we're really reaching tipping points where the dirty stuff will just fall away. Yeah. But those investments have to be made. This transformation doesn't come without those.
And they have generally high capital hurdles.
They do.
So if you can solve that cost of capital problem, you get lower cost operation afterwards, and therefore less stress on the economy.
Absolutely.
But it's that key initial hump you've got to go through. And emerging markets on the whole pay a lot for that kind of capital. So what kind of things could we do? What interventions into currency risk, policy risk, some transition risk, what could we do to get that down?
Let's finish off the scale and then go straight to the question you asked. So 2 trillion extra. Probably about half will come internally. That means from the public finances, and which of course you have to work hard on, as always, and from domestic private sector. I mean, Indian domestic private sector, South African domestic private sector, Indonesian domestic private sector, Brazilian domestic private sector, and finance are all pretty big. Right? So they will be following we hope, the technologies of the future, not of the 19th and 20th century. So perhaps half. It'll depend country by country, of course, but perhaps half of that could be internal. And the other half, perhaps 1 trillion, would need to be external. The big majority of that, private.
Yeah.
I mean, look around the world, 80-90% of investments private sector, and much of it indeed privately financed. So ballpark $1 trillion from outside, most of that private finance. And we've just been told, I hope plausibly, here at Glasgow, that there's 130 trillion of private finance looking for somewhere to go because they've declared for net zero for their assets under management. So it means that if we can get the examples right, if we can get the investment climate and conditions in a country right, that trillion from outside could come. So how do we get it right? And it's exactly what you said, James. It's managing, reducing, and sharing risk. Part of that is on the revenue side. You know, infrastructure investments in general need decent, moderately secure revenue flows. You know, if you're building a railway or building electricity, you've got to think, will those revenue flows be stable and the right kind of
steady,
level?
long-term contractual returns like power purchase agreements and
Exactly.
those like.
Exactly. People somewhat mistakenly say people want certainty. Certainty is not on offer in life.
No.
But you can
really recognizable patterns is what they want.
You can really reduce uncertainty, and this is about reducing risk and uncertainty. So part of it will be on the revenue streams, but a lot of the uncertainty and risk is around getting it done. And private sector worries about that. The institutions actually find it difficult to take the early stage risk in some of these programs, projects. So that's where development banking comes in.
Yeah.
And it can be local, domestic investment banking. We fought like mad to get the UK infrastructure bank.
Yep.
For a decade, at least a decade, we were asking. You and I and a few of our friends, we got it in here.
Yeah.
But that's the kind of institution that's got the ability to take long-term risk. Remember, it's not subsidy. No. That ability comes from its capital structure and who stands behind it.
Yes.
But that's not subsidy.
No.
These banks should make a profit.
Yeah.
And the more profit they make, the more they can finance.
But the sovereign backing helps.
Sovereign backing helps. The multilateral development banks are also very important here, particularly in these emerging markets and developing countries, because private sector firms, number one, they feel safer. Government-induced policy risk is a huge part of risk. So they feel safer in relation to the government if they're walking arm in arm with the multilateral development bank, with which the government will have a long-term relationship. They're also, if they use their instruments well, for example, they can take equity, they can give political risk guarantees. You know, they can have structures which morph from one thing into another if things go reasonably well.
Yeah, foreign currency PPAs or ways of creating buffers in case there's a risk to the asset.
So what they are institutions with capital structures and size big enough to take risks, which a lot of the private sector cannot take. But it's not just the instruments. It's very importantly the instruments, but it's the actual presence which reduces risk. I'll give an example. When I was chief economist of the EBRD before I was chief economist of the World Bank, and we had one firm, I'm allowed to give its name now and I will, but we had one firm which at that time in the early 1990s could have bought the EBRD, but they still wanted the EBRD with them because it reduced risk. And that was BP. I did check many. This was 20 years ago, and John Brown was there at the time, and I did check with John that I could use that example.
That institution, we've got to close off now, but that institution was prepared to go quite early on in the development, absorbing development risk in that transitional phase for the Eastern European economy.
But give me one thing at the end. You're absolutely right, James, but give me one thing at the end. So how can we put the packages together which can, number one, give us the scale, and number two, give us the risk handling, which can mobilize the private sector so powerfully? You've got to have the bilateral support. Right. That extra 20 billion that we've just been discussing from not supporting oil and gas absolutely could go into bilateral support. Support for the multilateral development banks, they have to step up. We're talking about big numbers now. Perfectly feasible numbers, but we're talking about bigger numbers in the past. They have to be able to step up their lending and they have to shift it over to green. A third thing is the the multilateral funds like the Green Climate Fund or the Climate Investment Funds, which are often, they're organized multilaterally, but they're separate from multilateral development banking, and they can give you concessional money,
Yes.
which is so important. Then you've got to get the private sector multipliers much bigger than they've been in the past,
Yeah.
number 4. And then number 5, you've got a collection of actually quite innovative ideas. The special drawing rights
Yes.
of the IMF, which have recently been created. We can do that again, we should. You've got the voluntary carbon markets.
Yeah.
That could be in the tens of billions.
Could be a factor.
Yeah.
For some things, it could be helpful.
And you've got philanthropy,
Yeah.
which, if you excuse the reference to a beer advert, can reach the parts that the other funders can't reach. And so what we should be looking for beyond the 100 billion, I mean, number 1, deliver the 100 billion. Don't move the goalpost. Just get on with it. Settle it next year, and we can. But we've got to think big beyond that. And we shouldn't be adding up things which we shouldn't be adding up, because they perform different roles.
Yeah.
You know, multilateral development banks, bilateral, the philanthropies, the private sector, they all play different roles in this jigsaw, and they support each other if you get it right. So that's the way we should look for the future. It can be done.
Can be done. That's the message. Thank you very much, Nick. And that's how we'll leave Nick. And I got to do my little bit of plugging you into today at the COP. And actually, what's interesting about today at the COP, and it relates nicely to the conversation we've just been having, is it's been Youth Day here. And there have been youth in the streets, there have been marches, there have been protests, there have been demands of our institutions, mostly our political institutions, but also our financial institutions and the investor community and businesses, to make this transition and to get on with it, because there is such an obvious and rather cruel inequity in the debt that has been delivered to the generations behind us, who face a future of some significant risk, and they feel it. It's an emotional response as well as a rational and analytical one, and that pressure that can be experienced, has been experienced on the streets today, will feed through. It will feed through in voting patterns. It will feed through in decisions in ordinary everyday commerce and buying things and making choices over brands. It will feed through into community action and self-organization and the ways in which people express their identities, where they live, how they live, and pretty much all over the world. I mean, one senses that, of course, there's a difference between levels of capacity to respond to this climate crisis, but the desire to represent the interests of the young is a universal phenomenon. And in those countries where they can be freely expressed, they're going to be very influential. So one of the things I thought I would just draw together today is that intergenerational equity issue will be expressed in various ways, in all of those ways I just mentioned, but also in the law, in the use of the law. I've just been speaking at an event on climate change and the rule of law, and packed audience at the university, people who are going to be looking to constitutional law, human rights, the rights of the child, types of litigation. And that kind of intervention, using the law strategically to change the rules of the game, are likely to have an effect, sometimes at the margins for investment decisions, but perhaps in a dance with regulation and interventions by regulators in the financial markets and shareholder actions. And there is going to be a connection that you will see unfold between that kind of protest in the street, the use of the law, the desire to see implemented these big commitments on finance, and the practice of finance itself. And that's really the message of today, that some of these big announcements on forests, on methane, on finance, the pressure to implement them will be intense when you see that desire expressed in protest and in campaigns. And when you ally that to the use of the law, that is a game changer. And I felt it today here.
Am I allowed to come in on
You
this
can.
one?
Yeah. Okay, got it.
Yeah. 2 areas where the young people are pressing very hard is where they work after they leave university, and where their pension money goes.
Yeah.
And those are two
those
huge
are big
pressures
levers.
that they are pulling. And I'm a professor at London School of Economics. Our students are actually on the right side of the market.
Yeah.
And they look at firms and they say, I don't want to go and work for an irresponsible firm. I want to work somewhere else.
Yeah.
You know, a firm like Unilever transformed under Paul Polman's leadership over a decade, taken forward by Alan Jope right now in next CEO. They get 2 million job applications a year. If you get the best people, you're going to do better than the people who don't get the best people.
Yeah, and if you and by contrast, if you don't get the people, you aren't going to thrive. No company's got any God-given right to continue to exist.
That's right.
I mean, you look at the index of stocks and shares and go back 5, 10, 15 years.
Yep.
They come and they go. And if you want to thrive, you need good people, right?
Yeah.
And if those people don't want to work for you because you're not doing the kind of work that they appreciate, you will not thrive.
And they are going to go to work and they're going to sign up for their pension plans.
Yes.
And they will sign up for money which is investing in the 21st century activities, not the last ones, because it's the decent, responsible thing to do, which weighs quite rightly very heavily with them, that will give them a future from the point of view of the environment in which they have to live, but also because those are the better investments.
They don't want to have declining returns in the latter end of their pension plan. Well, that's fantastic. Thank you, Nick. Thank you very much. We're going to leave it there for now, and then we've got some further interviews to do afterwards, haven't we? Thank you.
Good.